In this video, I'll discuss everything you need to know about educational savings and investing plans, and we're starting right now. Hey guys, welcome to another video from the Keystone Financial Academy. If you're new to this channel, I invite you to join our community by subscribing and turning on notifications so you don't miss any of the upcoming videos. Okay, so let's talk about educational savings and investing plans. What I'm talking about here are essentially tax-favored accounts where you deposit money and it gets saved and invested, and eventually you can pull it out to use for college or other educational expenses. Now, typically this is for your kids, but it could also be for any other dependents or even for yourself if you're thinking about coming back to college or trade school a couple of years down the road. This is a great way to offset the cost of education, which, as we all know, is a huge burden for the typical family, especially if you start saving and investing early. And the way most parents approach this is to open an account when their child is just born and fund it continuously through age 18 when they go away to college, and thus paying for most, if not all, of the higher education bills and not saddling their child with tremendous amount of school debt upon graduation. So clearly these educational savings and investing plans are excellent financial tools if you know about them and make use of them in a disciplined and consistent manner. So let's now go over exactly what choices you have and how to use them. The best known and most popular savings and investing plans for educational related expenses in the United States are the 529 plans. They're named after Section 529 in the Internal Revenue Code, which spells out the rules, and they're legally referred to as qualified tuition programs. They were formally introduced in 1996 as part of a Small Business Job Protection Act, and from the start they were meant to help taxpayers save money for education. The two major types of 529 plans are the 529 Savings Plan and the 529 Prepaid Tuition Plan. The much more common 529 Savings Plan is tax advantaged and qualified, meaning you contribute with after-tax dollars, with investment earnings and withdrawals tax-free on the federal and almost always on the state level as well. Now, something interesting to know about the 529s, although the federal government provides guidance on these plans, they were originally proposed by and currently administered by the states. Each of the U.S. states has its own 529 savings plan, with some states setting up more than one. And although all the 529 plans are essentially the same in structure, they do differ a little bit by their certain rules and regulations of that particular state. You do not have to invest in your own state's 529, so it pays to shop around and read reviews on performance and fees of each of the 529s. Now, I've mentioned investment earnings, so what exactly are you investing in? All 529 savings plans by law have to invest in quality stocks, bonds, ETFs, and mutual funds. And you almost always have the ability to choose the specific investments and allocate the proportions. If you're familiar with a 401k, then the 529 is somewhat similar, except here you're not saving for retirement, you're saving for educational expenses. An important point to remember is that invested 529 money can only be used for qualified college, university, or tech school expenses such as tuition, fees, books, supplies, and room and board. In recent years, tax reform laws have expanded the usage of 529 funds, and now you can use up to $10,000 per year for some K through 12 education as well, not just college. However, if the money is not used for educational purposes, tax will be assessed on all earnings and a 10% penalty will apply. The designated beneficiary of the 529 plan can be the donor's child, but as we mentioned earlier, it can also be a grandchild or other dependent. It can also be a spouse or even yourself if you're contemplating a return to college. The donor that sets up the 529 plan can be just about anybody, including a non-relative of the beneficiary. And finally, contributions to 529 are state income deductible up to a certain level, and this is something your accountant or financial planner can tell you more about. Now, if we use California's plan, which is a scholar share 529 as an example, here are some basic numbers. The minimum to open the plan is $25 and the maximum lifetime contribution limit is $529,000, which is coincident with the name of the plan. Now that to me is proof that government bureaucrats and bean counters do have a sense of humor, because they could have set the limit at $530,000, but they didn't. Well, anyway, you can invest in numerous mutual funds and bond funds, and the portfolios can be adjusted for you automatically. From being more aggressive and maximum earnings early on when your child is young, and then switching gradually to a more conservative portfolio where preserving the capital is more important as your child gets closer and closer to college age. There are fees, of course, for the managed funds, but low-cost index funds are also an option. So that is the essential info on the 529 savings and investing plans. There's some cautions here here with the 529 plans that has to do with financial aid and being able to qualify if you have a 529, but that is something your financial planner or accountant can tell you more about. So if you've never seen these plans or haven't heard of them and you have young kids, I encourage you to go to your state's 529 by just Googling the name of the state and the number 529 and see if this makes sense for you. It's very easy to apply for and open up one of these plans. You can do it all online, and then you connect your bank account to the 529 plan and money gets automatically deposited either bi-weekly or monthly, whatever amount you want to transfer over. Now, of course, it's impossible to predict how much money you'll need to deposit or how much tuition will cost at any given school 10 or 20 years from now, but it likely won't be any cheaper than it is now. And steady deposits over many years into the 529 plus growth from the investing will give you the peace of mind that if your child decides to go to college, you won't have to scramble at the last year or two before they go away to figure out how to pay for this. So the other type of 529 that I want to briefly mention is the 529 Prepaid Tuition Plan. These are far less common than the savings plan, and the 529 Prepaid Tuition Plans are pretty much exactly what they sound like. You prepay all or part of the annual tuition for a state college or university and lock in the tuition rate at the time of the payment. You're essentially loaning the state money in exchange for a fixed tuition. If that tuition goes up, which it will when your child attends college years down the road, you're not responsible for those increases. Prepaid 529 plans generally apply to in-state tuition, with 11 states listed right here currently offering the plan. While they can be applied to out-of-state schools, you're risking a penalty because the other state schools' tuition may be different. As far as private schools, there are very few private 529 tuition prepayment plans, so this is mostly a state college and a university thing. These prepaid plans do have a lot more limitations than the savings plans, so you really want to read about them carefully. And you can find more info about them on the state's websites from those states that offer them. Okay, so what other options do we have to save for educational expenses besides the 529 plans? Here are a few more to mention. The first is the Educational Savings Account, more commonly known as the Coverdell Plan. And this is another type of tax advantage investment account used for educational expenses. It was first introduced in 1997 and was named after its sponsor, the late Republican Senator from Georgia, Paul Coverdell. The Coverdell Plan is somewhat similar to the 529 in its intended purpose, but with a few differences. The most important of these is the fact that the Coverdell Plan has currently a $2,000 contribution limit, which is per child, and the beneficiary must be under age 31 when receiving the benefits in order to avoid penalties. One advantage of the Coverdell Plan is that it allows you to invest in a far more diverse set of securities for potentially more profit than the much more simple 529 plans. Another advantage, until recently anyway, was that the Coverdell Plan could have been used for a much wider set of expenses, such as from K to 12, not just college and university. However, in recent years, the 529 plans have caught up to that and can also be used for K through 12. Finally, the ability to open a Coverdell Plan phases out for high-income earners around the 190 to 220K annual income, and you receive no state tax benefits since this is not a state plan to run. In general, the Coverdell Plan is not likely to replace the 529 plans, but can be used in addition to them. To sign up, you can go through your broker, bank, or credit union. The last type of accounts I will cover are the UGMA, or the Uniform Gift to Minors Act, and the UTMA, or the Uniform Transfer to Minors Act accounts. Both the UGMA and the UTMA are examples of custodial accounts. This means they are protected accounts used to hold securities for a minor child until that child turns 18 or 21 or 25. The UGMA was first set up in 1956 and updated in 1966, while the UTMA was created in 1986 as an extension to the UGMA. These accounts are not tax advantaged, and also the adult custodian cannot specify how these funds are to be used when they're distributed later on. Hopefully the money is for college or some sort of higher education, but some beneficiaries have chosen to use the money to start up a business, which is also great use of it, but some also have spent it frivolously. Either way, the money is free of any encumbrances or conditions. What's the difference between a UGMA and a UTMA? Well, the main difference concerns the makeup of the accounts. A UGMA account is limited to purely financial products such as stocks, bonds, mutual funds, cash, and others. A UTMA allows properties such as cars, art, real estate, and even non-tangible items such as intellectual property. Also, while all states allow UGMA accounts, there are 2 states that don't allow UTMA accounts. And finally, the maturity dates of the 2 accounts are slightly different. The UGMA matures at 18, while the UTMA matures at 25. This is the age when you must hand over the account to the beneficiary. So why are these accounts created and what's the benefit? One advantage of both accounts is the simplicity and security. These trusts could be set up by lawyers or any other formal custodians, and once money is deposited, it cannot be accessed by anyone, including creditors or other family members. Only the beneficiary can retrieve these assets, and only after the age of the stated maturity. This type of account makes transferring complex financial instruments easy and ensures the money can't be touched until it's supposed to be. Both the UGMA and the UTMA can easily be opened at any brokerage or bank. Both accounts are funded with after-tax dollars, and both have some positive and negative tax implications having to do with the tax brackets of the donor and the recipient when they receive the money, as well as gift and estate taxes. And your accountant or financial planner can fill you in much more about this, including how it applies to your personal situation. UGMA and UTMA are excellent accounts and financial tools for the right circumstances. You really have to be careful in opening and funding these accounts because you, the donor, will not be able to access this money. Hopefully you also have a good relationship with your kids and they're growing up to be more or less responsible and will use this money in a positive way when they reach the age of maturity and are able to access the funds. Alright, so that was an introduction to the basics of educational savings and investing plans. As always, be sure to subscribe and hit that like button and let me know in the comments below as to what other topics you would like to see me cover more of. Thanks for watching, and I will see you soon.